Hello and welcome to SuperGrowth MultiBaggers. We build portfolios of high growth, high quality, low debt public companies based on traditional Graham and Dodd fundamental analysis of financial statement trends and other research to identify companies with emerging trends that indicate the potential to be multi-baggers, or companies that return 100 to 1 to their shareholders over a 10-year period. That translates to roughly 58% a year compounded. And obviously very few companies achieve this or are capable of this, but the ones that do share certain common characteristics: expanding margins, increasing return on assets, rapidly growing revenues, minimal or no debt. And we've developed software that combs through all the thousands of public companies looking for the 20 or 30 with this potential. And we buy them on weakness. We've developed secondary software that identifies trends over the last 12 months that have generated particularly high returns, and then extrapolates that onto the current stock price. So we'll quickly review all of this to give you an idea of what it is we do and how we do it. What you see here is the summary report, and we produce these almost every day. It's one page per SuperGrowth MultiBagger, starting with the company with the strongest financial statement trends. And so at the moment, Apollo Medical Holdings is the #1 ranked SuperGrowth MultiBagger. But this allows subscribers to scroll through and in a few seconds compare each public company with all others. And we try to communicate as much as possible using graphs because they can be understood at a glance. It's pretty clear, for instance, that the recent trends of Apollo Medical are very strong. And then down the side, we offer conclusions based on the data that the software accumulates and processes. So, growth trends very strong, profitability trends extremely strong, etc. And I won't go through it, but it's looking at everything from growth rates, momentum, is that growth accelerating or decelerating, financial strength, market cap, intrinsic value, and perhaps most important of all the numbers here, estimated annual appreciation potential over the next 5 years. In order to return 100 to 1, a company would have to generate a return of 58%. And if this company does as well over the next 5 years as it did over the last 5, it will return 99% to shareholders. So, and ends that 5-year period trading at the same relationship to intrinsic value as it has on average over the last 5 years. So there's a little bit of complexity there, but the basic idea is find really fast-growing companies with really strong financial statements where not only are they growing fast and have strong balance sheets, but they are improving in both those regards, and doing it in a low-risk way, at least as related to debt. Companies that can grow without debt. The reason that's so important is rapidly growing companies tend to need debt. They have to finance added inventory, they have to build plant and equipment, they have to spend money on research, they have to hire people. Those people take time to train before they can make a contribution to profitability. And all of this demands capital, and only very few companies can accomplish it without adding debt. And so those are the ones we focus on. That's what we're looking for. Originally, I got into this in a kind of circuitous way. I'd been a stockbroker and then a money manager in Toronto. And I moved to Wall Street, to New York City, to do some work for one client who was active taking large positions in public companies. And he would hire me to go out and interview former executives, former directors, customers, suppliers, competitors of companies he was interested in. And I would put together analysis that involved a lot of travel. I was constantly staying in hotels, and um, life, I was in my late 20s, so it was a little bit easier to do than it would be today. But um, when all this was going on, when I was doing all this kind of work, Buffett accumulated $1 billion position in Coca-Cola. And that really it captured my attention, because when he bought Coke, it was trading at 15 times earnings, which doesn't seem that high in today's market, but I think the average price to earnings ratio when he took those positions, which was like late 80s, was probably around 8, something like that. And he paid 5 times book value. At that time, I think the average of the market was just under 2, and 12 times cash flow. And the stock had been going up about 18% a year for several years prior to his purchase. So what was he doing? And what he was doing, what he did was he figured out that, or by studying Coca-Cola's financial statements, he noticed that the company was shedding low margin bottling operations all over North America, but also all around the world, and putting the money raised from selling those into expanding into emerging markets with rapidly growing middle class populations. And as a result, sales had started to gain momentum, and margins had gained momentum. So here I am flying all over the country, not at home with my young children, and instead, Buffett's sitting there in his office reading financial statements and understanding why trends that he sees are manifesting. And that had a profound effect on my research, because I started to do that and ultimately developed software to do it. When I wanted to compare every public company with all others, I turned to software. But in another example of a company that captured my attention in the mid-90s, this time, was Steve Jobs returning to Apple. And within a few months of him assuming the CEO position, for a while he actually didn't have a title. He was almost like a consultant there. But, he dramatically reduced inventory, I think, from 39 days to like 4 days, reduced number of product lines from 16 to 3. And what he did was reflected in financial statement trends within a few months. And he significantly reduced debt, paid off lines of credit. And so all of this was obvious to a student of Apple's financial statements. And it just seemed to me to be a much smarter way to go about research. First of all, it's based on fact, not conjecture. You're not predicting the economy, interest rates, the stock market, all of which, in my opinion, are unpredictable. But you're using the same kind of criteria that you would use if you were going to buy a private company. Margin trends, debt trends. So that it was these kinds of, it was becoming aware of these kinds of scenarios of rapidly improving companies and the ability of financial statement analysis to detect them, that led to the eventual creation of this research. The other primary element of what we do is buy on weakness. So we buy quality on weakness. And even the top performing companies, for instance, Netflix was the top performing S&P company over the decade 2010 to 2020. Even Netflix experienced several significant declines in price in that time. So it experienced 5 declines of more than 30%, one of more than 80%, and this is the top performing stock. All of these, well, on average, the decline was 47.3% in that 10-year period. So the second element of what we do is we attempt to capture these swings, many of which are emotion driven. A company can report a bad quarter, people get afraid about the economy or whatever. Stocks are just known to fluctuate, and it just seems to make a lot of sense to buy quality when it's weak. So we've developed secondary software that detects these patterns and knows and identifies patterns that repeat, that have generated high returns based on buying quality companies, and the quality is identified by the financial statement trends, buying quality companies on weakness. And I'm just going to quickly show you how, this is a little video I prepared for subscribers, so the transition is a little abrupt, but it'll give you a quick idea of how that algo works. And I think we use Apple in that as well. What we're looking at here is the Python code running. It's running on 112 companies. The first one's Apple. It downloads thousands of hours of price data, high, low, and close for each hour for the last year or so. Then it attempts to identify patterns that both repeat and are particularly profitable, and it extrapolates those patterns onto the current stock price and reaches a conclusion on buy at and sell at price. So in the case of Apple, for instance, it runs these formulas that are pattern recognition formulas, and the stock closed yesterday, Friday, today, Saturday, it was at 127.79. The patterns that it detects indicates a current buy price of 110.72 and a sell price of 132.07. And on average, using this pattern, it has bought at average price of $102.04, sold at $124.50, profit per transaction of 22%, average period held 1.2 months, return annualized 216%. So the last time that it bought was in May, this month, actually earlier this month, May the 4th or 5th, at 119.24, and the last time that it sold, $133.34 on April 8th, and so on. You see down here the different buys and sells that the pattern is using to determine the current buy and sell price. Going back into 2020, of course it was buying in March, bought at $53 and sold in April at $66, approximately 2 weeks or so later. So that's how the prices are achieved, or how the prices, the buy at and sell at prices in the risk research portfolio are determined for each of the companies that you see there. So to quickly review, to review quickly, our research is based on 2 primary elements: fundamental analysis of financial statement trends, basic Graham Dodd credit analysis, business quality, quality of franchise, quality of management, protectable advantage, are all reflected in financial statements. All what we've brought to the party, so to speak, is an ability to compare these trends and data in every public company in comparison or relative to all other public companies. Second, buy on weakness, buy quality on weakness, particularly weakness that may indicate emotion or, panic. So, sometimes people say, "Hey, you're buying a falling knife. You know," but we base our decisions on probability analysis, and we have many times bought falling knives, and we will continue to buy falling knives if the price movement is extraordinary and offers extraordinary value and potential. In that discrepancy between stock performance and business performance, there's a lot of opportunity. And it happens, I don't know, once a year, twice a year, once every 2 years, but, the market gets this idea that the sky's falling and great companies are offered at discounts. And we don't care. Now, I will say we do have a very modest stability pattern recognition built into the formula. So I guess I'm contradicting myself now, but yeah, if it was $100 a minute ago and now it's 90, we're probably not going to step up. But if it was 90 an hour ago and half an hour ago was 80 and now it's 82, we're very likely to be participating in that kind of scenario. All right, so I guess another thing to quickly show you is to access the detail. These are the summary reports, one per company. To access the detail report on any particular company, you click on the company name. I'll make this a little smaller so you can see the whole. You click on the company name, it takes you to a detailed report. It starts with a 5-year trend and our conclusions here. In this case, it's showing the rate of change. This is not growth. It's whether growth is accelerating or deteriorating. So in the case of Quidel, you see the rate of growth has dropped significantly in the latest quarter. It's still positive, but it's just not as positive as it was in the 2 prior. Now, these are not quarters. These are 12-month periods ending a quarter ago, a quarter before that, a quarter before that. So this, for instance, is the 12-month period ended March 20. This is the 12-month period ended March 21 in this particular case. This is of particular interest, overall financial statement momentum. So while the momentum of growth has slowed, the momentum of financial strength has continued to improve. That's why it gets a neutral rating here. These are the growth charts. And you see, very substantial growth. It just happens to be not as steep as it was in the prior quarter. This is not applicable. This is dividend coverage analysis and whether or not the dividend is secure. But of course, Quidel doesn't pay a dividend. So long-term chart, you see this company struggled along in a kind of sea of mediocrity here for many years, and then it broke through. This breakthrough was well before COVID. So it broke through and now has been on a phenomenal upward trend. This is our assessment of net asset value. And I'll talk about that a little bit in a moment. And this is the stock price. So it appears to us to be very undervalued right now. Return on assets analysis, strong trend. Rate of improvement slowed, as with growth. But here we see margins. Here we see asset turnover. Operating free cash flow, debt trend, capital expenditures. Debt, none in this case. This is the financial strength analysis. You see the trend here. Equity, debt. Company has no debt, so it's been flat for a while. Free cash flow is a percentage of all liabilities, not just funded debt, but accounts payable, etc. Cash is a percentage of all liabilities, strong. Okay, net asset value. So what we have developed this software that looks at price to revenue, price to dividend, where there is a dividend, price to free cash flow, price to earnings, and then it does, it compares the maximum value of those various different approaches, and so maximum on its own, maximum to median, maximum or minimum to median. And so it looks at like 7 different approaches to value, and then it identifies the one that's been most reliable in predicting stock price and in relation to the stock price, and it uses that one to assess the current value. So in this case, it's saying that this gray line has been the most reliable indicator of value over the last 10 years. Well, I'm sorry, I shouldn't say. We do for another purpose, do analyze it for 10 years, but actually for this purpose, it's actually 5 years. So you see here, our analysis indicated that the stock was overvalued, and here it indicates that it's undervalued, substantially undervalued, 50% undervalued, which is rare for a company with these kinds of profitability trends. And then finally, back to the summary report, we put it here so that people don't need to click around too much to find it. Free cash flow, return on assets, financial strength, and price to net asset. Just very briefly, we've been amazed working with this data over a period of many years, how reliable this indicator is in terms of predicting future stock price. It's this. Of course, it is dependent on free cash flow trends, because if you have, in fact, strong free cash flow and weak financial statement trends, you probably either have an Enron or you have a Netflix. They're capitalizing expenses that, it's distorting free cash flow. So we just avoid those. I'm not saying Netflix is a lousy company or a bad investment. I'm just saying that's not for us. We want cash. We want a cash. We want companies that generate a lot of cash. So, Netflix doesn't meet our criteria, but that doesn't mean it's not a great company. Okay, so that's it. I think I've covered everything that I want to here. I thank you for taking the time. I guess I'll just sum up by saying we don't predict the future. We don't predict earnings or the economy. But we've run businesses, studied accounting, and we know how to develop software. And out of that has come this unique research that is based on data. We try to express our conclusions with as few words as possible and back them with graphs that can be understood at a glance. We also offer a separate service for clients with larger portfolios. That's fairly expensive, so it only is feasible for larger portfolios, but it's $1,000 a month, and we run this analysis on all the positions and watch list holdings and potential holdings of clients, and give them a risk analysis and a potential analysis on each one. And we set up virtual computers so that they can run the algo, the buy at and sell at algo I showed you earlier, throughout the trading day, and access it whenever they want. And thanks for your interest in the research, and please don't hesitate to contact me if you have any questions, and you can subscribe on our website. We have a bunch of, instead of a trial, we have a lot of research available via YouTube, our YouTube channel, which you can access on the sitemap page of our website, and there's also a number of Seeking Alpha articles which give you a good idea of our research and allow you to sample it before subscribing. And thank you again.